I welcome everyone to Energy Frontiers edition for the week, proudly supported by the African Energy Chamber. I am Justina Okechukwu, and let's get started with some of the biggest energy news around the continent. The National Oil Infrastructure Company of Zimbabwe, which is responsible for pipeline transportation and storage of petroleum products, is increasing the capacity of its Feruca pipeline from 2 billion to 3 billion liters per year by September, boosting the second phase of the infrastructure to 5 billion liters. The company is also building a 2,000 metric ton liquefied petroleum gas storage facility. Vallourec, a French manufacturing group, has secured a contract from Total Energies to supply nearly 5,000 tons of OCTG solutions and services for the Caminho Deepwater project in Angola, which is located 100 kilometers off the coast of Block 20. The contract includes Vallourec's providing its VAM connections and clean well technology, an environmentally friendly, dope-free solution to enable the delivery of offshore expertise. African-focused upstream oil and gas company Afentra plc says it sold 900,000 barrels of crude oil at an average price of $84.03 per barrel in the first half of this year, generating pre-tax revenue of $75.9 million. The company now plans to sell an additional 790,000 barrels in August and has hedged 70% of these at $80 per barrel. Tag Oil of Canada announces the production of 400 barrels of oil per day from the Bed 4 T100 horizontal well in Egypt's Bada 1 oil field, with an associated gas-oil ratio of 150 cubic feet per barrel. The company has started shipping crude oil for further treatment and handling. Revergo Fund Managers, a South African-based renewable energy-focused fund, is seeking new investors to raise about 3 billion rand or $165 million to expand its portfolio. The fund says it is planning to list once it manages $500 million in assets. Revergo currently has a pipeline of potential investments worth 10 billion rand. And that's the summary of your energy news headlines. When the show returns, we get analyst perspective on some of the most important global oil market news of the week. Stay with us. Welcome back to the program. The outlook on global oil demand continues to send mixed signals across the market. While the International Energy Agency forecast oil demand growth averaging just less than 1 million barrels per day for this current year, the OPEC group maintains its bullish position, forecasting demand growth of 2.25 million barrels per day. Julien Mathonniere is an oil market economist at Energy Intelligence. Earlier today, Julien shared his insights on the current state of the oil market and strategies for oil traders and investors in hedging risk in the near term.
So far, I'd say the first half of the year, demand has been a bit disappointing, especially the first 5 months of the year. But there is still hope that the market will improve in the second half of the year. We'll see larger deficit, and this is going to support the price and to support demand. So if you look at the price of Brent oil, it's been holding at more or less $85 per barrel for nearly 1 month. But if you look at the price structure, it has moved into deeper backwardation. So the price for immediate delivery is higher than the price for later delivery. And this is because there's expectation that crude balances in the third quarter will get tighter. So, markets are still looking at an average deficit of 1.2 million barrels per day this year, with tighter balance in the second half of the year. Next year, however, balances flip into a sizable surplus, potentially approaching a 1 million barrels per day surplus. And the huge supply deficit we see this year, they increasingly reflect, if you want, OPEC plus withholding supply rather than exuberant demand. So I would say this is something you have to keep in mind. This is not so much about exuberant demand. This is about OPEC, keeping some sort of hand, keeping some sort of control on this market. So it makes the situation very tricky for OPEC plus, because they might have the space to unwind their cuts in the second half and bring back some barrels. But if they do, they might have to cut back again next year. I'd say that's the overall situation at the moment.
Right, that's interesting. So, with all of this, what's your take on both OPEC and the IEA's recent global oil market outlook? We have those divergent views and worries about if OPEC will be able to balance the markets and hold on to prices without the voluntary cuts or not. So, what's your outlook on that?
Well, it's interesting that you've just used the word divergent, because I'm using that word as well. And I think the answer is there are differing views on China. I think that was the most shocking aspect that came out of the reports this week. Both forecasters' views on China have been steadily diverging. According to the International Energy Agency, China's oil product consumption contracted in April and in May and is now below its year-ago levels. So, it's not improving compared to 2023. It's not doing as well, basically. It's degrading. And, the IEA has used the word, I think they said China's preeminence is fading. That's the expression that they use. China preeminence is fading. They wrote that in the report yesterday, highlighting that China's share of global demand growth has receded from about 70% last year to an expected 40% this year and next year. So the IEA now sees China, China's oil demand growing by only 415,000 barrels in 2024. And if you remember, back in March, their forecast for China was 600,000 barrels. So for 600,000, they're now down to 415. And back in March, when their forecast about China was 600,000 barrels, the forecast from OPEC was 630,000 barrels. So, IEA and OPEC were almost the same about China in March. Now they've completely diverged. We've got 415,000 for IEA, and I think OPEC is now at 873,000 barrels. So more than double the IEA. That's just incredible. Their views on China are at loggerheads. They're going in opposite direction. And I think for me, that was the most shocking aspect of their reports. They're completely different views about Chinese demand.
Right. Now, BP 2 days ago had its energy sector outlook report out as well, and still maintained that having those two scenarios where seeing that oil prices will still, oil demand, however, will still have that peak, just as the IEA had said earlier on. Do you align with BP's latest energy outlook report for 2024 and beyond?
Well, we do align, Justina, with BP on the fact that renewable power sources, such as, for example, solar and wind, are failing to grow rapidly enough everywhere in the world to meet the projected growth in energy demand. So if you take Europe, for example, policies have been playing a major role in the deployment of more sustainable energy sources. It's also working. More people are using solar panels, maybe just one or a couple, on the roof of their houses to supply renewable power to their own houses. I'm sure that if you take Africa, however, policy support is almost inexistent outside, say, maybe fuel subsidies. And fuel subsidies, of course, are for oil and gas, not for renewable power or for solar and wind. And therefore, if you want to deploy renewable faster, then I think rich countries must intensify their support to poorer nations. And this is exactly what BP said. And I think we are in complete agreement with that.
That was Julien Mathonniere shedding light on some critical developments in the oil market. For the full and in-depth conversation, visit our website at www.frontierafricareports.com. Let's step now into Angola after this short break.
We are done dreaming of an industrialized Africa. No more enduring long journeys in darkness. No more imagining life without constant power. We are done. We are done. Done tolerating 24 hours without power, load shedding, blackouts, and power cuts. Enough. Imagine a life where our abundant natural resources can't power a generation. We can't cope with that reality. 600 million Africans still lack access to power. We have the solution. It's time to turn imagination into action. African Energy Week 2024 is the platform to implement change, sign deals, and take decisive action. And implement. Join us. Invest in African energies. Energy growth through an enabling environment, and be part of the movement that brings hope to millions across the continent. It's not just about power, it's about empowering lives and giving African hope. Be there to witness the transformation. African Energy Week 2024, where imagination becomes reality. Secure your seat now. Don't miss out on African Energy Week 2024. Visit our website and buy your tickets today. Let's light up Africa and create a brighter future together.
Project. At the time you need to build that project. Sign, baby, sign.
Angola is set to launch a bid process in early 2025. The top African oil and gas exporter will be offering 10 blocks in the Kwanza and Benguela basins, including 5 marginal fields. This initiative by ANPG, Angola's upstream regulator, looks to attract investors to explore these frontier areas and encourage production-focused strategies to develop long untapped discoveries. Alcides Andrade is a board member of the National Oil, Gas and Biofuels Agency in Angola. In this webinar with the African Energy Chamber, Andrade outlines other emerging investment opportunities across the country's hydrocarbon market ahead of the 2025 licensing round. Take a listen.
We have been implementing a series of reforms driven by the reorganization of the oil and gas industry in Angola that started in 2017. In 2018, we had some reforms to bring additional contractual, legal, and fiscal incentives for new opportunities in the current producing fields, as well as new projects that we had in the pipeline, marginal fields, mature fields, as well as new concessions. So as part of the reforms, we approved a strategy to license more than 50 blocks in 2019. And the projection is for us to license more than 50 blocks by 2025. So far, we have executed 4 licensing rounds and have awarded more than 30 new concessions. And we have another one planned for 2025 where we are projecting to put up for licensing round another 10 blocks offshore. Now, in the context of mitigating the production decline, we have, as part of the reforms, introduced initiatives to bring production from producing fields in the near term, as well as with the exploration strategy and the licensing strategy, being able to bring additional resources and reserves that put us in the position to have a sustainable industry and a sustainable production going forward. The plan is to do everything we can to maintain the production above 1 million barrels. Right now, we are producing about 1.1 million barrels of oil per day, and we feel we have been able to stabilize the production decline.
This is Energy Frontiers. A key challenge for the global energy system over the coming years will be moving from an energy addition to an energy substitution phase, and that's according to the energy giant British Petroleum. BP released its annual energy outlook in the week under review, forecasting that oil demand will plateau by next year, with a decline rate depending on the aggressiveness of countries' action. However, the energy giant warns that clean energy additions are being outpaced by energy demand, leaving the door open for the use of fossil fuels over the long term. Here is an excerpt from that webcast for you.
Energy sustainability and energy security remain huge issues shaping the energy landscape. Despite the hope and ambition at the time, carbon emissions have risen in every year since the Paris climate goals were agreed, other than the COVID-induced drop in 2020. The carbon budget is running out. And the fallout from the war in Ukraine means the importance of energy security has once again come to the fore. But in sharp contrast to 2011, the 2024 version of energy security highlights the dangers associated with globally integrated energy markets and dependence on imports. This updated version of energy security instead stresses the benefits of increasing reliance on domestically produced energy, or at the very least, on obtaining energy from resilient, trusted, diversified resources. I know the concept of the energy trilemma, the importance of energy systems providing energy which is secure and affordable, as well as sustainable, may feel a little stale, a little out of date. But I would argue its relevance has never been greater. Any successful and enduring transition needs to address all three elements of the trilemma. And those three needs play a central role in informing and shaping this year's energy outlook. The world is in what might be called an energy addition phase of the energy transition, in which both types of energy, old and new, unabated fossil fuels, low carbon energy, are both growing. And we see previous examples of energy additions in history. In the mid-19th century, when coal grew rapidly and supplanted wood and other biomass as the world's primary energy source. And roughly 100 years later, when the rapid growth of oil meant it overtook coal as a dominant energy form. In both those previous periods, the world remained in the energy addition phase, consuming similar or growing amounts of the old energy, even as it adopted the new. The world has never reduced its consumption of any fuel on a sustained basis. It's just consumed more of everything. And that's the historic challenge facing the global energy system. If the world wants carbon emissions to fall, it can't remain in the energy addition phase indefinitely. The energy system needs to move from energy addition to energy substitution, in which the growth of new energy, in this case low carbon energy, exceeds the increase in total energy demand, causing the old energy, unabated fossil fuels, to decline. The common trend is that this historic shift from energy addition to energy substitution happens in both scenarios, albeit with different timing and intensity. In current trajectory, the energy addition phase continues in the 2020s. You can see in the 2020s as a whole, the growth of low carbon energy increases even more, but still not enough to meet all of the growth in energy demand, and unabated fossil fuels, shown here in the black bar, continues to rise. That changes in the 20s and 30s and 40s as we start to see unabated fossil fuels start to decline. But the extent of this energy substitution is relatively limited. Unabated fossil fuels still account for 2/3 of primary energy in 2050, compared to a little over 80% today. The shift to the substitution phase in net zero happens sooner and with greater intensity. The energy system moves into energy substitution in this decade. You can see those black bars already falling in the 2020s, and then gathers pace in the 2030s and 40s, such that by 2050, the share of unabated fossil fuels in primary energy declines to just 15%.
The African Energy Week 2024 train is on the move towards November 4 to 8 in Cape Town, and you can't afford to be on the rails. Join the biggest industry event of the year, which will spotlight a dedicated hydrogen summit to explore Africa's potential for the green resource. The high-level gathering will also feature current projects and future investments, including professional advisories on how the continent can achieve its climate goals and foster global partnerships. For more details, visit www.aecweek.com today. And that's how we lower the curtain on this package of Energy Frontiers. We appreciate your making the time to watch the show as always. Remember to follow the program on Frontier Africa Report's website, like all the video editions, send in your comments, and subscribe to our YouTube. Kindly follow us as well across all our social media handles as indicated on the screen. I am Justina Okechukwu. Bye-bye.